All right, let's just get right into it. Welcome back to Iron Financial, The Explainer, where we forge stronger portfolios and completely cut through market weakness. Look, right now, the broader macroeconomic environment is basically a pressure cooker. We're seeing incredibly volatile interest rate expectations, lingering inflation fears, and a market that is just desperately searching for some kind of structural stability. So against that intense backdrop, today we are conducting a strict structural audit of one of the absolute heaviest hitters in the entire wealth management space. We are dissecting the Charles Schwab Corporation's Q2 2026 earnings report. Management came out swinging this morning. They printed what looks, at least on the surface, like an absolute blowout quarter across literally every major business line. We are talking massive top-line growth, seriously expanding margins, and an asset-gathering machine that frankly seems unstoppable. But the market's reaction? It tells a slightly different, much more complicated story. Exactly. And honestly, that is the hook here today. Because if this quarter was such an undeniable slam dunk, why did Schwab stock wobble and then slide exactly 1.5% in pre-market trading the very second these numbers dropped? You read management's PR spin, and it is heavily focused on their massive top-line beat, the booming client engagement, all this record revenue. But as everyday investors, we've got to look past that headline gloss. We have to ask the tough questions. Is this actual, sustainable, structural strength, or is it just temporary market hype that's masking some really deep cracks in the armor? And that is exactly what we are here to uncover today. But before we start ripping up the floorboards, we have to look at the sheer scale of the headline number here. A record $7.07 billion in net revenues for the quarter. Just let that sink in for a second. Generating over $7 billion in a single 3-month period, especially in this turbulent rate environment, that requires an incredibly resilient, heavily diversified business model. That is a massive foundation of raw capital flowing through their ecosystem. By the way, if you want raw, no-nonsense financial analysis that actually digs into the numbers that matter, make sure you hit subscribe and ring that bell right now, because we are about to perform a structural audit of Schwab's balance sheet, and we are absolutely not just taking management's word for it. Let's really break down this true earnings power. I want you to notice the staggering operating leverage we're looking at here. That's $7.07 billion in net revenues. That's a 21% year-over-year jump, cleanly beating the Wall Street consensus estimate, which was sitting at around $6.90 billion. But what is honestly way more impressive to me is the surgical precision on the bottom line. Their adjusted earnings per share came in at $1.62. That doesn't just beat the $1.53 consensus or the whisper numbers around $1.55. It completely crushes it. We are talking about a 42% jump from a year ago. Hitting that level of EPS growth in today's wealth management space is exceptionally difficult. Think about it. Firms out there are battling intense yield compression and sky-high tech infrastructure costs. To navigate all that friction and still beat consensus by nearly 10 cents means management is executing flawlessly on their cost controls while totally maximizing revenue capture. Even if we look on a strict GAAP basis, we're looking at $1.54, which is up 43%. Look, this isn't just incremental growth. This is a company firing on all cylinders to generate pure, unadulterated earnings power. And the absolute crucial point here, the thing you really need to understand, is how they are actually converting that top-line revenue into actual profit. Schwab's adjusted pre-tax profit margin expanded to a massive 54.3%. Compare that to the 50.1% they posted back in the second quarter of 2025. What this brilliantly illustrates is immense operating leverage at scale. They essentially expanded their margin by over 400 basis points by keeping their structural fixed costs, things like corporate real estate, legacy back-end infrastructure, base headcount. They kept all of that relatively flat. Meanwhile, they simultaneously allowed their high-margin, scalable revenue streams to just explode upward. When your revenue expands by 21%, but your fixed costs barely budge, well, every marginal dollar drops straight to the bottom line. That is textbook margin expansion, plain and simple. So where exactly is this $7.07 billion coming from? If we break down the core operational pillars, we've got $3.36 billion from net interest revenue. That is the undisputed heavyweight here. Then $1.83 billion from asset management and administration fees. Trading revenue is kicking in a very healthy $1.22 billion, and bank deposit fees round out the major segments at $333 million. To aggressively contextualize this growth, I really want you to notice that every single one of these load-bearing walls expanded double digits year over year. Net interest revenue, which is their primary engine, grew 19%. Now, this was heavily driven by an expanded net interest margin of 3.00%. That's up 12 basis points sequentially from just last quarter. Crossing that 3.00% threshold is a massive magic number for Schwab. It signifies they are optimally balancing the yields they earn on their massive bond portfolio against the cost of deposits they have to pay out to clients. They are finally overcoming the rate hike cycle's early squeeze. Elsewhere, asset management grew 16%, powered by organic growth and much higher utilization of their wealth solutions. Bank deposit fees surged 35%, and trading revenue rocketed up 28% to $1.22 billion. Okay, wait. I gotta jump in right here and push back on that last point. Trading revenue up 28% sounds amazing on a press release, sure. But when you start peeling back the layers, this was powered by a record 11.9 million daily average trades. Guys, that is a 57% year-over-year explosion in trading volume. As a skeptic, I have to ask, is this really a structural foundation we can rely on long-term, or is this just a temporary market frenzy? We all know equity markets have been incredibly volatile lately, and retail engagement always spikes during turbulence. If the market goes flat tomorrow, doesn't that 11.9 million number and all the revenue attached to it just completely evaporate? It's a really fair question, but listen, you can't just look at trading volume in a total vacuum. You have to look at the sheer weight of the foundation that is feeding those trades. Total client assets climbed 22% year-over-year to a staggering $13.08 trillion. That is trillion with a T. This isn't just churn from existing clients day trading. They brought in $119.8 billion in core net new assets this quarter alone, up 49% from Q2 2025. June was an absolute record month, pulling in $62.7 billion. Furthermore, the organically opened 1.4 million new brokerage accounts in just 3 months, bringing their total to roughly 48 million accounts. The lifetime value of those 1.4 million new accounts is astronomical. Once Schwab gets a client into their ecosystem, they cross-sell them asset management, banking, and high-margin lending products for literally decades. So yes, market volatility definitely drives trading in the short term, but this asset-gathering machine is permanently expanding the base of potential wealth. And to prove this isn't some fragile house of cards, let's look directly at the raw balance sheet data. Their total cash and cash equivalents, including restricted amounts, sits comfortably over $73 billion. This demonstrates the immense liquid bedrock that is supporting these massive structural inflows. Think about it. When you are operating a $13 trillion platform, you need impossibly deep reserves to facilitate margin lending, daily bank sweep transfers, and massive daily settlements. This $73 billion cash position proves they have the raw liquidity to aggressively expand without straining their capital ratios one bit. And aggressive expansion is exactly what they are doing over on the credit side. Let's drill really deep into their high-yield lending engine, because this isn't just about holding cash, it's about deploying it. Bank loan balances hit $67.0 billion, up 33% year-over-year. Pledged asset line balances rocketed 59% to $33.4 billion, but the most explosive metric here, the one you really need to pay attention to, is margin loans. They soared 30% sequentially, meaning quarter over quarter, to a whopping $165.1 billion. This 30% sequential surge was primarily driven by massive ongoing demand from registered investment advisors, or RIAs, who are implementing incredibly complex long/short strategies. These are highly sophisticated institutional plays where RIAs borrow heavily on margin to short overvalued equities while simultaneously leveraging up their long positions to maximize yield. By servicing these high net worth RIAs, Schwab is successfully monetizing their massive asset base through rapid, highly profitable credit expansion. They are basically weaponizing their balance sheet.
All right, I hear you on the top line, and the asset gathering is undeniably huge. I get it. But I absolutely refuse to accept only the bull case today. Like we said at the top, there is a reason this stock sold off in the pre-market. I demand to know where the real risks are hiding here. We need to look for the actual cracks in the armor. What on earth is happening with their expenses? And how is Wall Street actually valuing this so-called liquid bedrock? When we still have sticky inflation data and the constant looming threat of unexpected Federal Reserve rate pivots hanging over the entire financial sector. If the macro environment turns sour, how insulated are they really?
Okay, fair play. I completely concede that point. There is some serious structural friction we have to address. Yes, the bottom line was protected by sheer volume, but GAAP expenses jumped 12% to $3.4 billion. Even on a strictly adjusted basis, expenses are up 11% to $3.23 billion. Why? Well, higher client engagement costs money.
More trades inherently mean higher back-end execution and regulatory fees. But much more importantly, there is the heavy, heavy lifting required for integration. Back in March 2026, Schwab completed the $636 million buyout of Forge Global to force their way into private market trading. Forge gives clients access to pre-IPO startups and private equities, right? But integrating an entirely new, incredibly complex private shares platform into a legacy public market brokerage is a notoriously heavy, staggeringly expensive lift. You are dealing with entirely different regulatory frameworks, totally different liquidity constraints, and wildly different settlement mechanics. That integration is currently bleeding pretty heavily into their quarterly run rate.
Exactly. And it is not just internal friction either. We're seeing real analyst friction too. BMO Capital just downgraded Schwab from outperform to market perform, slacking a $105 price target on the stock. Look, if the fundamentals are so incredibly unbreakable like you say, why are major analysts pulling their buy ratings right now? It makes you really question if the broader market is pricing in a macroeconomic structural trap here, because if rates shift aggressively, or if retail engagement suddenly cools off, those rising integration expenses are going to absolutely crush that beautiful 54% profit margin you were just hyping up. And that right there is the ultimate balancing equation we have to weigh today. On one side of the scale, you have the yielding pressure from potential future rate cuts, which could absolutely compress that 3.00% net interest margin, plus those rising integration expenses we just talked about. But on the other side, Schwab is aggressively building new structural pillars for the future. They just officially launched Schwab Crypto, finally giving retail clients direct access to Bitcoin and Ethereum trading. Crucially, though, they are sub-custodying this through Paxos. This is a massive, massive deal for regulatory compliance. By using a highly regulated chartered trust company like Paxos to hold the actual underlying assets, Schwab completely isolates itself from the counterparty risks and hacking vulnerabilities that plague standard unregulated crypto exchanges. This makes them a much safer bet for institutional and conservative retail capital. They also rolled out their new generative AI portfolio insights. So yes, costs are up, but they are spending heavily today to ensure they remain the apex predator in wealth management tomorrow. So what is the definitive verdict here? Well, if you're a long-term investor, Schwab's high-yield lending engine, their incredible fee expansion, and that staggering $13 trillion foundation offer a highly solid blueprint for compounding wealth over time. The asset-gathering machine is simply too powerful to ignore. They are acquiring accounts at a blistering pace and successfully monetizing them through a really robust suite of lending and asset management tools.
Right, but if you are a short-term trader, you have to be incredibly careful right now. The rising expenses, the integration friction from Forge, and the immediate macroeconomic turbulence create very real, immediate structural traps. Just think about the actual mechanics here. If the Federal Reserve is suddenly forced into emergency rate cuts due to a sudden economic contraction, Schwab's net interest margin is going to take a direct, brutal hit. That 3.00% NIM could compress rapidly, essentially choking off their primary engine of revenue. Furthermore, if the broader equity markets stall out and retail trading volume dries up, not only does that $1.22 billion in trading revenue evaporate, but the demand for those highly profitable margin loans plummets as well. Traders will rapidly deleverage, pulling capital straight out of the system. That 1.5% drop pre-market, that tells you the street is hyper-focused on those exact near-term risks. You basically have an impenetrable long-term foundation that is battling some severe short-term margin pressures.
And that brilliantly illustrates the absolute core tension of this earnings report. Will Schwab's massive, high-yield lending engine and unyielding structural asset growth absolutely crush the macroeconomic turbulence in front of us? Or are those rising expenses the very first sign that this $13 trillion foundation is actually starting to crack under its own weight? That is the question you have to answer before allocating a single dollar of your capital. Thank you for joining us for this structural audit on Iron Financial. Remember to stay sharp, stay subscribed, and keep your portfolios forged in iron. We will see you in the next explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.